So today we are having the lesson on the comparison between increase and decrease in provision for irrecoverable debt. These are the vocabs that we are going to use throughout the lesson. And there are two questions given here. One is related to increase, another one is related to decrease in PID. First of all, you need to open these ledgers: a trade receivable ledger, irrecoverable debt ledger, and another one we are going to open provision for irrecoverable debts. Right, so we are going to do the same even for the other side. Open a trade receivable account, irrecoverable debts account, and then another one, provision for irrecoverable debts. Once we are done with this, we need extract of income statement and statement of financial position on both the sides. And we are having two specific headings under income statement. One is for other income, which we add, and another one for expenses. And under statement of financial position, we write current assets. Under current assets, trade receivable, and then we deduct provision for irrecoverable debt, which is the closing balance. Same we do here. We add the other income and we deduct the expenses depending on the situation. Under SFP current asset, we write the trade receivable and deduct provision for irrecoverable debts closing balance. Now we are done with opening all the ledgers and the extracts. Now it's time for us to post the opening balances. Trade receivable 50,000 will appear on the debit side of the ledger. Irrecoverable debts on the debit side because it's an expense, and provision for irrecoverable debts will appear on the credit side. So let's enter the information. Let's go to trade receivables account on 1107 as balance brought down, worth 50,000. And then irrecoverable debts worth 3,000 on 1107 as balance brought down. And provision for irrecoverable debts we have worth 1,000. So let's enter 1,000 on the credit side. 1107 as balance brought. Now we are done with entering all the opening balances, and then they have said at the end of the year, provide further irrecoverable debts worth of 2,000. So for this particular one, we have a debit entry and a credit entry. We debit irrecoverable debts account and we credit trade receivables account. So let's go to irrecoverable debts account. On the debit side, 2,000, which occurred on 31st/12/07. Opposite account's name is trade receivables. Then go to your trade receivables account on the credit side. Opposite account's name irrecoverable debts, worth 2,000. Now once we are done with this, we have to balance the ledgers. So let's balance off the ledgers and find the closing balance. You can see that the debit side is greater, 50,000. 50,000 take away 2,000 gives you 48,000, which you write it as balance carried down 31st/12/2007 and 1108 balance brought down worth 48,000. And then this balance you balance it and transfer it to income statement. Debit side is greater by 5,000, so 5,000, 5,000 and 31st/12/07 income statement under the category of expenses. Now let's show this impact. So we have 5,000 in our irrecoverable debt, which should go under income statement. So I'm writing here as irrecoverable debts. And trade receivables we had worth 48,000. Let's transfer that over here. Now we are done with this. Now we have to calculate provision for irrecoverable debt. So provision for irrecoverable debt here states it's 10% of our closing provision trade receivables. So let's calculate, take this 48,000 and calculate 10% of it, which should give you 4,800. Now, how are we going to write this? 4,800 on the debit side, 4,800 on the credit side, 31st 1207 as balance carried down, and then 1108 as balance brought down. Now we are going to balance the ledger. We can see that the debit side is greater, 4,800. Take away 1,000 gives us 3,800. So here there is an increase in provision for irrecoverable debts. Therefore, it should go under income statement expenses. 31st 1207. Now, go back here and you're going to transfer this 3,800 under expenses as increase in provision for irrecoverable debts, whereas you're going to transfer the closing balance of 4,800 over here. Now this is for the increase that we had done. So you can see the entries that we had posted, how we calculated and how we had transferred it to income statement and asset. Now let's have a look at decrease in provision for irrecoverable debts. First of all, let's enter all the opening balances. First, TR balance 50,000 on the debit side because it's an asset, and irrecoverable debts on the debit side and provision for irrecoverable debts on the credit side. So 3,000 here, 1107 balance brought down, and over here on the credit side balance brought down. Let's see the value, which is worth 1,000. Let me change the value of irrecoverable debts, provision for irrecoverable debts here. I need a higher figure, and let me change this into 2,000 because we need to show the impact of decrease. So over here, provision for irrecoverable debts worth 7,000. Once we are done with this, we calculate further irrecoverable debts worth of 2,000. We debit irrecoverable debt account and we credit trade receivable account. Let's show that impact. So it's on 31st 1207, irrecoverable debts worth 2,000, and then 31st 1207, irrecoverable debts account, opposite accounts name trade receivables worth 2,000. Now let's balance the trade receivable account. You can see that the debit side is greater, 50,000, 50,000, take away 2,000 gives 48,000 as balance carried down, 31st 1207. And then 1108 balance brought down 48,000. Now let's take this 48,000 to statement of financial position on the current asset. Now it's time for us to balance the irrecoverable debt account. Debit side is greater, 5,000, 5,000, 31st 12/07 income statement. Now let's enter this 5,000 under the expenses in income statement as irrecoverable. Now we need to calculate provision for irrecoverable debt. Our closing balance is 48,000 trade receivables. 48,000 into 10% gives us 4,800. Now let's show this impact over here. 4,800 on the debit side and on the credit side. 31st 12/07 balance carried down 1108 balance brought. Once we are done with this, show this 4,800 over here. Now let's balance off provision for irrecoverable debts account. Now you can see that the credit side is greater. So 7,000 take away 4,200. $1,200, I guess. 2,200, which should go to income statement under the income. 31st 12/07. Now where are we going to show this? In the income statement under other income as decrease in provision for irrecoverable debts. Now let's have a comparison. As you can see, there is no change in trade receivables account. We get the same balance, 4,800 and 2,800 here. Irrecoverable debts, again there is no difference, but you can see provision for irrecoverable debts. In situation 1, first it's 1,000 and then it's 4,800. That means provision for irrecoverable debts had increased by 3,800. Therefore, it should go under income statement expense. Whereas in the second situation, provision for irrecoverable debts had reduced from 7,000 to 4,800. So it's 2,200, which should go under income statement under the category of other income. So this is how we explain the two comparisons between increase and decrease in provision for irrecoverable debts.